All right, so joining us again on the show, he is becoming our favorite guest, Mr. Steve Frost from National Mortgage Funding. Thanks for jumping back on to talk about a highly controversial topic, and that is the fact that the government, as of this week, have decided, or it appears as though, this is why we have you on the show, to penalize those that have been responsible, paid their bills on time, have a great credit score, and reward those who haven't, that are looking to buy a house this year. So welcome back to the show.
Thanks, man. Thanks for having me.
Yeah.
What a wonderful topic.
Yeah, it is a
How are we getting ripped off this week?
Yeah, it's interesting. And the mainstream media is having a field day with this. But before we jump into the conversation, I want to share just a minute or two of a video from Meet Kevin, who I think does a really nice job framing this thing up for the audience, Steve. So let me share my screen, and I want to show this first.
Well, good old Joe Biden and the Biden administration are now bringing affirmative action to real estate. Maybe not directly, but to some extent, yeah. There is now a new announcement out from the Biden administration that, listen to this, they are going to hike payments for good credit home buyers to subsidize higher risk, low income, minority borrowers. That's right. So if you've done right with your finances, you have a higher credit score and a higher down payment, you're now going to have to pay a higher monthly payment to subsidize people who just didn't operate their finances as well. On one side, people are arguing, hey, well, in fairness, maybe you had the better opportunity to go to a better school because you were in a minority. On the other side, people are like, F that, I worked my ass off to get where I am, and I shouldn't have to subsidize somebody else. That's the government's job, not my job. Government shouldn't be making it more expensive for me to operate because somebody else didn't do as well.
All right, so that kind of frames it up as to what's happening. Every media outlet right now has their own spin on essentially this information that was just released. So I know you had sent me some information, which we'll share with the audience in a few minutes. But Steve, what is your take on this?
You know, unless it's something that there's like some new report other than what I think this is, like the whole affirmative action spin on it and all that kind of stuff is like a ton of sensationalism, honestly. What you're saying is that if you're a like let's call it marginalized demographic or like a non-white demographic, they're saying has bad credit, right? Is essentially what is how all that's coming across. Because what I'm trying to think of a way to not get like too into the weeds and too technical. But what he was mentioning in there is something that we call an LLPA, right? Which is a loan level pricing adjustment. And so in mortgages, everybody talks about paying points, right? Isn't that like this is a number one question people ask. They say like, all right, hey, Bob, isn't that your name you use? Bob or Tom?
Yep. Bob
your interest rate on your 30-year fixed is 6.375. Your cash payment's this, cash goes. They're like, okay, how many points does that come with? So the number one question, so LLPA, which is what you're going to hear this a lot because this story is not going to go away, right? So an LLPA are points that every lender that does a conventional loan has to charge you for risk. And so there's like credit. It's like a matrix of credit score on a purchase transaction, right? So for a purchase transaction on a primary home, and I guess on any home, it's like how much you're borrowing and your credit score puts you into different buckets and you pay more.
Should we show the audience?
Yeah, you can if you want. Yeah.
So why don't you walk us through what you're talking about, right? So
right.
On the screen right now, for people that are listening to this on the podcast, Steve, we're showing a matrix of people that have a certain credit score and the amount of risk associated points that are charged to that home buyer for the loan in which they get. And so why don't you walk us through what the audience is looking at?
All right. So if you look at this matrix, right, and there's you'll see there's like 3 pages of these. We're only focusing on this top one, purchase money loan. This is somebody buying a house, credit score, and LTV. So LTV stands for loan to value. That's how much you're borrowing compared to the value of your home. So if you're buying a house and you put down, let's just say 10%, your LTV is 90% because you owe 90% of the value of the house. That's that ratio that you're looking at right there. So just for perspective, these are what changed, or all of these numbers that you're currently highlighting, right? So let's just stay in that column where you're putting, this is saying you're putting down between 5% down and 9.99% down, right? So you're not in the 10% down bucket. But either way, this is a great example. If you look at it, if you have a 743 credit score, right? So you go 740 to 759, and you go down, you're going to pay 0.625 points. So if you're borrowing $100,000, you're going to pay $625 in points or fees at closing for putting down 10% with that credit score. Okay.
Now let me jump in. So that makes sense, and thanks for sharing the matrix, because it helps the audience to kind of
right.
visualize this. What's changed? Why is this story such a big deal? What you just said, I'm with you. I totally get it.
Right.
Is that more than are people, in fact, that have better credit, are they in fact being charged more now?
Yes. So last month, or not last month. So these actually all came out in February. So we've known about this for a while. They're being implemented. So these have actually been priced into loans since like early March. And the main reason for that is because they have to be priced into the loan because they go into effect when those loans are sold to Fannie Mae and Freddie Mac.
May 1st, from my understanding.
Yeah, May 1st. So anything that's bought by Fannie Mae or Freddie Mac after May 1st is subject to these. So if you lock a rate April 15th, your loan is already priced into that. As a matter of fact, if you locked a loan April 1st and your loan doesn't close until May 2nd, you're subject to these fees because Fannie Mae is buying that loan after May 1st. So all these fees have already been built into rates. But yeah, so before this all happened, a 740 credit score with 10% down would have cost you a quarter point. And so now it costs you 5/8 of a point. So it's gone up $375 for every $100,000 that you borrow. And that's right. So they raise prices. The part that everybody's pissed off about is that if you have a 640 credit score, that might have cost you 3.5 points. So if you go down to say you got a 642, right? Let's not go below 639 because that's just like ugly country. Okay. So if you go 6 and you're doing that same loan, 90.01 to 95, you're paying 1.875 points. That was probably in the past 3.5 points to do that loan. So they made that cheaper for those borrowers. But the part of that you have to understand is that when I get that borrower, they're not getting a conventional loan. Like that borrower is not doing a conventional loan. The approvals are much more, to do 5% down with the 643 credit score. It's really hard to get that loan approved. You're going FHA on that loan every time.
So let me ask you this. Why is the media making such a big deal about this?
I mean, because you can, I guess, so if you think about it, like it's Fannie Mae and Freddie Mac and FHFA, so Federal Housing Finance Administration governs those two things. Fannie Mae and Freddie Mac are not the government. They're government sponsored entities, but those are companies that generate profit. Like that CEO of Fannie Mae gets a fat ass bonus when Fannie Mae makes more money than they are projected to make. My opinion is that, yes, they're charging more to offset some risk, but where they improved the pricing was not a Fannie Mae loan. Those are not FHFA loans. In my head, it looks more like they took the most common loans that they do at Fannie Mae and Freddie Mac. They said, okay, most people that do these loans have 680 to 740 scores. They put between 5% and 15% down. We're going to increase the fees on all those buckets. We're going to raise those fees everywhere. We're going to call it increased risk or ways to subsidize risk. All they're doing, in my opinion, is it's another way for them to make more money because that's their primary target. Like,
there's an argument that's being made that, in fact, the government is taking from the people who have been more responsible, taking from the argument was, I saw another article that was take from the rich, give to the poor. In fact, that because of what you just said, that the most common mortgage that is backed by Fannie Mae, we're going to take those mortgages, make those more expensive for the people that have been responsible with their life, their behaviors, that have paid bills on time, that have saved money. We're going to make it more expensive for those folks so that we can make it more affordable for those that have been less responsible. That's the argument that's being made, is it not?
Yeah, 100%. And I don't look, I'm on the same side. Like, I don't like charging people that. I'm in the bucket, like I have the good credit and the more money down, like I'm going to pay more too. But that lower end client is the part of that the media is making look bad, right? Is saying that like, if you have great credit and you've got all these things, you're going to pay more than somebody that's got worse credit. When if you look at those adjustments, that person that's got the worst credit is paying significantly more still. They're just paying less than they would have in the past. Right. Which, in my opinion, you can call it Peter Panism, right? Robbing from the rich and giving to the poor.
Not
you can
Peter
call
Pan. You mean Robin Hood.
Is that who it is? I don't know. I suck. I'm over here literally right now thinking about peanut butter. That's as far as I go with Peter Pan.
That's Robin Hood. Steal from the rich, give to the poor.
Yeah, Robin Hood. You got it. So you could, but for me, it's more of they're trying to dip into that less, or maybe that like demarginalized pool of borrowers to get away from the FHA. If you notice, FHA came out this year and lowered their terms. They made FHA loans a lot more appealing than they did conventional loans. So I think this almost looks like a way to try to capture more of that lower end borrower from Fannie or from that FHA and bring them into Fannie Mae and Freddie Mac.
Well, what it also looks like is potentially the counter argument to the ones that feel as though people are getting penalized because they've been responsible. The counter argument to those folks is you're making home affordability or home ownership more of a possibility to more people. The same way that the 1% down mortgage that we talked about on an episode earlier this week is doing. That's the counter argument. It says, why are you guys so upset? All this is doing is, to your point, making it more accessible for more people to buy homes. What's so wrong with that? That's essentially what you're saying.
Right. And here's another piece of this too, is that again, and this goes back to being a creative loan officer, but if all those LPAs that you see there, if you make less than 120% of the area median income. So yesterday we were talking about 50% or less, you get 1% down. If you make less than 120% of the area median income, you get to waive all those LLPAs if you're a first-time home buyer. If you make less than 100% of the area, or if you make less than the 80% of the area median income, you don't pay any of those LLPAs, great credit or bad credit, doesn't matter.
Interesting.
If you are a first-time home buyer and you make less than 100% of the area median income, you don't pay any of those LLPAs. There's a ton of incentives out there. And look, a $72,000 income, that in my market, right? That's 80%. $6,250, or that's $72,000 a year, $6,250 a month. I can get you a $3,000 mortgage payment. Not saying we max everybody out, but you just use one borrower's income. And there's ways around a lot of those fees, which is getting away from the topic here, which is, are we playing Robin Hood or not? And yeah, probably. And it's not, you always say like, it's not fair, right? But I look at it the same way, like the price of a Cadillac Escalade is up like $16,000, right? Like, and you can't negotiate. You cannot negotiate the price of a Cadillac Escalade. If you're like, hey, I'm totally into the Escalade. If you can do it for $1,400 a month, they're like, oh, are you almost done here? Because the next guy that wants it's on his way in, they don't care. But if you do that on a Chevy Equinox, they're like, yeah, I got 14 of them on the lot. Let's work on your payment, like the cheaper car, and you can get a better deal on it. It's like I don't know. I don't even know if that makes sense. That was just on my mind.
Yeah, no, it does make sense. And Steve, we appreciate your commentary like always.